All right, stocks finished the week about as good as you could, right? We had yields moving higher today. We had technology leading, semiconductors being a major part of that. Big names like Apple breaking out, a really good return on Apple today. We had some stocks do really well with their earnings releases. Breadth improves minimally. It didn't improve a lot. We're still kind of weak on the breadth. But as I mentioned before, if we're weak on the breadth, but we're rotating between sector leadership like industrials or anything like that, that's not what we want. We got the right sector leading the ways higher here. The Mag 7 names leading the way higher. We don't know how much longer that's going to last. And I break that down in today's video as well as to how much, where and when and if, some kind of weakness or softness will occur and what that will look like. I'll break down as well as the intermarket moves. There's some interesting moves today. Like I said, in yields, in the dollar, commodities, looking like they're trying to form a bottom. We'll break all that down. Very interesting sector rotation as well. Like I said, technology is our big winner, but that wasn't the only big winner. There's two others that outpaced the S&P this week. We'll break those down. And then our trade idea of the day is actually in the healthcare sector, which has gotten beaten up here recently, except for this stock. This stock has a nice little breakout pattern going on, and we'll talk about how to trade them. So let's go ahead and get started. Today is Friday, August the 8th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, if you're watching this on our blog, make sure you subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you down there on today's video. Share it with others. Join our website at MarketScholars.com for free. With our basic subscription, you get access to our Market Outlook blog posts that we do every day, as well as the lowest tier that we have available is our Market Outlook Foundation tier. For $29 a month, you get access to our full versions of the Market Outlook video, as well as the trades that accompany them day after day. You can follow me on Twitter for more content between the videos from day to day, as well as join our Market Outlook Facebook group that we've created. If you want to watch our Market Outlook videos and you're not logged in, this is the page that you get to. Again, you can get full access to our Market Outlook posts by just clicking on this to join free. That gets you to our subscribe page. Join. You can join now. All you have to do is just fill out here with a username, your email, and name that goes along with it. Then you get access to the blog post right here. You get the Market Outlook preview, as well as the summary of everything that's going on in the markets. And then again, to get the full version of this video, you have to join our foundation tier, right? So you can click on any of these buttons here, or just go to Foundation, Market Outlook Foundation. That takes you to this page. And then you can see here everything you get with that, including our Market Outlook live video and the Market Outlook Trade Tracker. Again, you get a $29 a month, less than $1.40, or for the yearly, you get 2 months for free at $2.99 a month, and that gets you access to the full version. Same blog post, but the full version that you're seeing the preview of here today. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line is turning higher again. It's up now almost to the 80th percentile. So we're back to dark green shading as a result today. You notice still have the green line because we've been above the moving average, all except for that one day where we were yellow, which was last Friday, where we were yellow there. Every other day this week, we've been just gradually moving higher. Even the down days had a higher high and higher low aspect to them. So as a result, the intermediate lines turned higher again because of the down days, because of the gap that we had on last Friday, and we still haven't really filled it all the way in. The near-term line, although it's in bullish territory, is not in the upper reversal zone. So it's not strongly bullish. And again, it's still below the intermediate line, with the intermediate line between the reversal zones. So we're still not, there with the short-term pattern. The momentum line finally came out of bearish territory for the first time, and we'll see how far it gets here to the upside. We are 1.5%, as you can see down at the bottom, 1.5% above the moving average, but still it's not necessarily the strongest short-term sentiment there. And as a result, we don't have very much of an intermediate posture. We're strongly bullish, but it's tenuous there. And But when you look at, like, again, what rallied today, we'll talk about this more, but you still had technology and semi. It's the same thing as we've been higher all week. It's been narrow leadership, but it's the narrow leadership in the area of the market that we want it to be narrow, right? It's if we're going to have narrow leadership rather than be in like energy or industrials, right, which are good cyclical areas. They're correlated with economic growth expectations, but when they outperform the markets, then, especially if they're the only ones outperforming the markets, that generally means the markets are going south because they have a negative correlation. Their ratios with the S&P have a negative correlation with the S&P itself. So if they're outperforming, usually the S&P is dropping. So, but, our narrow leadership, of course, is in the mega cap space, right? And so as long as that's the narrow leadership, then we're actually just fine. We might not be exploding to the upside, but at least we're pointed to the upside and we're avoiding any kind of declines here. And that's kind of what we're seeing. Because if you look at the NASDAQ 100, which I think is largely Mag 7 names, I think it's like 40% or something like that, Mag 7, very, very high percentage. It got a new high today. It got a new all-time closing high today. And its intermediate line is also back up. This case, it's back into the upper reversal zone. The short-term sentiment line, the near-term line, actually did get above 80 yesterday because we rallied. And then we finished, it continued higher today into the reversal zone. So it's not the greatest short-term sentiment pattern either, but at least it's gotten above 80, right? And we have filled in the gap, and we got new highs, and things are looking good from that perspective, even if the momentum line is like barely in the bullish territory. But again, coming off of extreme lows that we had on Tuesday, the only down day the NASDAQ 100 had for the week. The Dow Jones has been kind of underperforming. It underperformed again today. It's still not back above the moving average. So the yellow, the line's been yellow this entire time, all week long, because we got below it on Friday and we stayed below it all week. Right? We never did rally back above it. Its intermediate line is a lot further to the downside, still in bullish territory, just at the bottom, and it turned higher today too, though barely, right? And still, like I said, at the bottom end of bullish territory. The near-term line, with the intermediate line between the reversal zones, the near-term line crossing below it, is still relatively bearish. The nice thing is that with the near-term line dropping, barely dropping below 40, the momentum line already bouncing, that would suggest that this near-term decline is probably, there's probably not much more to this bearish near-term decline, and probably a pretty good chance that we bounce off of that early next week. And then finally, we'll take a look at the Russell 2000, which has also been underperforming. It was only up 0.15 of a point, roughly. Its near-term line also dropped into bearish territory, but again, momentum line coming out of oversold levels. The near-term intermediate line bouncing up, barely outside of bullish territory. Barely. It's like, again, just right off of that 60th percentile. But we're still 0.5% below the moving average. So again, we haven't, we only had one day this week that we were barely above the moving average. We got that bull tag the next day, and we've been bearish this whole time. Relatively bearish this whole time. Again, underperforming, I guess, would be a better way of saying this whole time. So the Dow and the Russell, which kind of represent more of a broader look at the markets, are clearly underperforming, and the NASDAQ 100 is the clear outperformer, and that's what make, again, large percentage of that is Mag 7 names, and if we're going to have, the NASDAQ 100 or the Russell 2000 outperform, we'd rather have the NASDAQ 100 outperform. That doesn't mean that at some point in time the Russell can at least kind of match it and come close to the same returns and still be really bullish itself. But if the Russell's outpacing the Qs and we're getting the broadening trade, that's generally not correlated with risk appetite. It's more correlated with risk aversion. Let's take a look at the weekly chart. Here, let's start off on the market forecast first. On its weekly chart, since this is the end of the week. You can see the intermediate line still strongly bullish, market sentiment turning higher, close to getting above the 80th percentile. We're well above the 5% mark, above the 30-week moving average, so pretty strongly bullish from that perspective. Bouncing back up. We expected this week to be a bounce back week, and we got that, right? That's what we talked about in last Friday's market outlook. We bounced back up. The near-term line's down, but again, not down very much, and probably won't go down much lower because the momentum line's already bounced. We had that bullish intermediate confirmation signal last week, and we bounced off of that. When we take a look at the Hakinyashi candle, Again, another transition candle, but we are closing way above this week's Hakinashi close. So we're expected that we'll probably bounce back up above the average down here in terms of the size of the body next week. So we're back to being relatively bullish. We're over the 5% mark. We can still go a little bit higher, right? Not too much higher, but we can go a little bit higher and stay a little bit higher on this. So we have a really good opportunity. The other weekly chart we like to look at here is the whole moving average. And you can see, again, that same Hakinashi candle. And again, we're nowhere near flipping the parabolic SAR to the upside. So that's that. Now, again, if you are a member, a subscriber of our classes in portfolio management today, I talked about this 28% return that we've had off of the low point. And then, okay, so where do we expect to be on early April next year, right? Because at that point, we'll be a 52-week return. We're on pace right now for a 90% return by next April. That's the pace we're on, a 90% annual return. We're obviously not going to get a 90% return from off the April low point to next April. Right? That's not going to happen. Right? It's very rare. The VIX would have to be like extraordinarily high. The two times the VIX has been the highest after the great financial crisis and after COVID, they produce like 52-week returns closer to 60%. And we did not get that high, nor did we ever stay anywhere near that high because we dropped so fast in the VIX for this low point that we're not going to get anywhere near 60% return or 90% return, which means we're going to really slow down the pace of the rally that we've had over the next 8 months until we get to April. And so you're going to start to see, some like we're seeing here. Look at it slowing down. We're trading below the moving average, the 20-week whole moving average, even if we're slightly above the 200-week whole. The parabolic SAR is really ramping up pretty quickly. The size of the candles have been gradually getting smaller, though we may bounce up for a little bit here in the next week or two. But over the course of time, we're most likely going to get some kind of weakness here as we're getting a lot closer. You can see as the numbers, as the dots get a lot closer, you're getting set up more and more for that reversal. And like I said, I don't think that happens next week. I don't think it happens the week after that. I think we still have probably a few weeks here of of upward decline, and you see that here in the seasonality of the S&P. A lot of people talk about the volatility rising. Well, right now, from this point, right about this point here, going forward into the end of the month, beginning of September, it's a pretty good bullish run. There's some ups and downs, but you get a pretty good, decent bullish run on the S&P during this time frame. Let's take a look at the 3 green arrows, and you can see that we have green arrows, right? We don't have 3 reds. We have 3 greens on the Qs. The MACD finally did turn positive. We're pretty close to it on the S&P. So 3 greens. Again, the NASDAQ is leading the way. We just barely left 3 reds on the diamonds today with the stochastics turning up, but you're still below the moving average. You still have a bearish MACD, and you can see the same thing on the Russell 2000. We're kind of more consolidating than we are bouncing. We still haven't really bounced up strongly to the upside. If you take a look at the 2-line version of the S&P, again, we are above the 8-day moving average, right? The 8-day and 17-day are both rising. The MACD is about, like I said, about to cross. The stochastics already has crossed above its moving average and is back in bullish territory. Let's take a look at some of these other oscillators. So just give me 1 second here. The DMI is still showing positive. We're above 25 on the positive indicator. We're below 20 on the negative indicator. So we still have a pretty good ADX here above 25. So that looks good. The RSI and the CCI. So here's a really good aspect too. We jump back above 60. So now I can edit this and bring this all the way up to today, right? Because now we've been bullish. Because again, when we cross below 50, you stop turning it green until you either break below 40, in which case I turn everything red from that point, or we bounce back above 60, in which case I turn everything green from that point. So we just turned everything green as a result. The CCI is back up above 0 and working its way up back into bullish levels itself, ideally getting above 100, and we'll see if that ends up being the case. I can actually bring this to today as well. So really good bullish signs there on both of those. The Ichimoku cloud still shows a very strong bullish trend. That's great. The weekly trend is just still developing, right? We're almost almost getting to the point where we cross up, to mature levels. Now, that generally has meant some just softness, right? Nothing major, but softness over the next little bit. So again, keep that in mind. Again, I'm not expecting a correction anytime soon. The parabolic SAR, or the rate of change, would have to go negative, and it's got to get over into this area before it goes negative, right? Just like it did right here. So like that doesn't look like it's happening anytime soon. When it came off of this peak here, it was above. It never crossed through these levels anywhere until up in this space. So we could be above this line for quite a while. Same thing, really over here is where it crossed back through and was positive again. Brief little downturn at the very bottom of that pullback that we had in October, September through October of 2023. So a nice little run here. It's very strong trend. That's not ending anytime soon. And then if I were to take a look at the intraday move here the Bollinger Bands. Let's take a look at the Bollinger Bands. Again, we're not above the upper band, but we are back in the upper quartile of the bandwidth, a relatively low bandwidth. The bands are still inside the Keltner channels, but the momentum turned back up today. So again, that's a very positive note for the S&P. Finishing the week on a very positive note. Higher highs and higher lows. We close a little bit above. I guess in the after hours we moved up a little bit more. So a little bit above last week's high point, 400ths of a point officially. But again, like I said, after hours are up even more than that. So we're at least at the high, if not above the yesterday's high. Obviously a higher low, a gap, a common gap, so there's likely that's going to be filled in, so keep that in mind. We might start next week with a little bit of weakness before turning up higher again, just to fill in the common gap, nothing too major. And then you can see like the positive indicator on the rune has dropped below 70, so we haven't had a new high, we haven't had a new low, for quite a while there. So that's that generally, and we have a very, very tight 4-week range, very tight 4-week range. So, we are set up for a breakout move. And, again, generally speaking, that leads to breakout moves to the downside. But that doesn't mean that we can't, kind of get a consolidation breakout to the upside. That's still a possibility. And we might get a little bit of a short-term breakout to the upside, which is kind of what I'm expecting. Make it look kind of like a fake-out type pattern before we finally get, our intermediate decline. So you'll push up to new highs a little bit. You can see the low will push up here in a few days to this low, so not much. I think we'll get new highs. I just don't think that it will push up very, very strongly up to the upside. Maybe a couple percentage points more here. All right, let's take a look at today the volume in the trading range, which again was relatively small. Remember, this is very small averages, and so the volume at 63, the range just under 4 points. That puts our ATR here under 0.1% still, so that's still very bullish levels, but not extreme. The volume is still relatively elevated, so that actually can come down more. That's a reflection of the money flow. The money flow is still holding at good bullish levels and has the opportunity to bounce, right? We can break too, but we have an opportunity to bounce off of it. You would expect it to bounce until it doesn't, right? Until it doesn't there. Let's take a look at the VIX lastly. And you see the VIX is down almost to 15 again. So we finished last week above 20, and just like that, boom, we are way back. In fact, we are already way down almost to 80%, so 82%. Very low. The VVIX is down again, but not below 90%. Which is where we want it to be. If we want to get below 15, below 90%, then we can just grind to the upside and feel really good about life. But so we're still a little susceptible, to an oversold bounce and volatility. And again, if there is one next week, I think it would coincide more with a near-term decline. I don't think we're I know the signs are out there that we're in this intermediate pullback, but I don't think we are yet. I think we still have a couple more weeks left, at least a week or two left of some upward moves, building on what we saw this week, before we have any indications at all of intermediate pullback. All right, now let's talk about what's driving this price action. And like I said before, it was a relatively narrow day, but it was narrow in the way we want it to be narrow. So here, let's pull up the asset class comparison chart. And it's less narrow than it has been. I guess we can put it that way too. You can see the Q's up. Again, the 3-month highs, very strong 3-month returns, outpacing everybody, including IWM, and that's going to be a theme here. If you take a look at August the 8th, and then this just is today. Okay, so there's the Q's relative to IWM. So I wanted to bring up the ratio chart of the Q's to IWM. So let's bring that up here. And you can see just how, I mean, this is the highest close we've ever had on this. This is, a very strong week. It's well above 2.5. It's well above 2. I mean, just getting to 2 was overbought, like in terms of like historically high levels. It had been above 2 only during the tech bubble, and now we've been above 2 since end of 2023. Had that little pocket of weakness in the fall of 2023, but the Q's actually outperformed. That's why the correlation dropped. And then it came back to being positive. So then, as the market rallied, it rallied too, and everything has been fine. Very, very big. I mean, look at this. Since the beginning of 2023 to now, just for some context on this, let's go all the way back to the very beginning of 2023. Since that ratio chart has just taken off, the Q is up. The Qs are up 115%. The S&P up 66%. IWM is up 26%. That's it. And all these other international markets are all doing poorly. And the dollar's been down during that time. Now, it's been up a good chunk of that time, but it's down here lately, and especially been down since off this low, and the Qs are still killing. It doesn't matter if the dollar's stronger. It doesn't matter if the dollar's weaker. The Qs are still just killing everybody, right? Everybody over that time frame, but especially IWM. And that's important because we want it to, right? If you look at XLK, which is the most important sector in the market right now, and where a lot of the strength in the market is coming from. You can see its ratio. When we broke above the 17-day, you can see it broke above its 50. The ratio chart broke above its 50-day average. We've been bullish and taken off ever since. It's been consolidating. We've been kind of converging here on the relative strength, but it's still above 100. So the relative strength chart is still above 100 there. We're still, this is still looking really, really good, especially again when you compare it to, the market itself, or especially when you compare it to like XLE, all right, which would be, again, like I said, the sector we do not want to see outpacing the market, and XLK is just killing, and that's what we want, right? See how it's 87% positively correlated with the markets. If I look at XLK relative to SPY, still above moving averages, still strong, 95% correlated with the S&P. We're above 60 on the RSI. We're turning back up here on the PPO to potentially new levels. Let me give you some context on the strength of that, or how high we are on that long-term PPO of the 15200. It's bullish, but not nearly as bullish as it can be, right? As it has been when we made this run, or when we made this run here in 2020, COVID, or this one in 2023. So, this thing can really, we don't have new highs yet on XLK relative to the markets, even though the Qs themselves are giving new highs. So it's, we're strongly bullish on the positive indicator being above 30. Like everything's looking really positive here, very, very positive. And that's what we want. That's the narrow leadership. That's great. That's fine. But that's the narrow leadership that's kind of leading the market. The breadth is better today. It's still not positive. So it's still not expanding. So if I look at the breadth here, the McClellan oscillator, we still don't have an expansion of the breadth. It's negative here on the McClellan oscillator. We're still breaking below 500. When you look at some of the other breadth indicators that we like to look at on this, for example, the number of stocks above the 50-day moving average, give it a second to load up here, is still, it's still below, it's up today, but it's still below 300, well below its average. Number of stocks above their 200-day moving average, a little longer term view, so it's slower, but it's also, below 300, below its moving average that's falling. The number of new highs that we're getting is at 96, so that's actually a pretty decent number, back up where the average is still slightly above the average. And the new lows, see, we don't want the new lows to get above 72, and we've been okay, right? If it gets above this 4% level, which is, double that 72, so if it gets up, or 2.5%, 72. So if it gets up, to this 4% level, then that's the level where it's like, okay, we're either starting in a decline or we're at, we're really washing out. So, we started over here and then washed out with a big move on new lows. Over here, that ended up being kind of the lows when we broke up to those extreme numbers and new lows on the S&P. So we're above the average, and the average is rising, but we're not above 72, and that's when you really start to worry about the Hindenburg-Omen, and that's the 2.5% mark, and that's when you start to worry about breaking above the 4% mark and working in that direction. So we're not there. The breadth is still okay. The net new highs and lows in both the Nasdaq and the New York Stock Exchange are right around 100. So again, relatively positive. The percent index here finishing the week down really low. So this is the second week that it's closed below its moving average. It's on a weekly chart. And this is what it looks like on the daily chart. So a big break. You can see it's dropping. It's a big break on the number, again, the number of stocks in the S&P 500, percentage of stocks, excuse me, in the S&P 500 that are showing bullish patterns on the point and figure. So we're below 60, which is the bullish territory, but we're not in the bearish territory. We're not in the lower half of the chart, nor are we below 40 when we're really bearish. So we're just kind of in neutral levels, but not bullish, right? And that's, again, a sign of weakness from a breadth standpoint. So we're still, but as long as that narrow leadership, again, is not like rotating between utilities one day and energy another and industrials another, and it's just been pretty much XLK, then we're fine, right? And that's the case here when you look at the sector comparison for this week. Here, let's go for the whole week here, because it's been up and down, but the story's been the same all week long. Narrow leadership. Every day we've been up. It's been technology. It's been one of the biggest leaders. And there's, we finished the week up almost 3.5%. Discretionary finished up almost or a little bit more than 3.5%. Staples is really the only other sector that had a really good, that outpaced the S&P. Everything else underperforming the S&P, and that's okay. I mean, at least they're still positive. They all had positive weeks, but we want them to underperform because, again, their ratio charts with the S&P are negatively correlated. They tend to outperform the S&P when it's lower, when it's falling, and these mega cap sectors are all lagging the market. So breadth is looking positive. The rotation is still into technology. As you saw on the 3-month chart, technology is still the big winner, up 23%. It's the only sector outpacing the S&P over the last 3 months. So it's still the big winner. You still have other cyclicals that are, up. They might be lagging, but they're up. And that's okay. So semiconductors is still looking really strong. That's a key part of the market right now, and it's back to bull after kind of getting a quasi bull tag pattern. It's turning back up again, and so the strength in the market is where we want it, and we're not seeing a whole lot of other the 10-year yield is rebounding back up. We want it to rebound back towards that 4.5% mark. So that's actually a really good short-term sentiment bounce, even if that momentum is still slightly below. The dollar bouncing up off its moving average, as we thought it would. We talked about that. It's bouncing up off that moving average, but this barely, right? It's not taking off. If it were to really start to change, it's one thing for it to go up. It's another thing for the rate of change to start to significantly go up. And right now, the 26-day rate of change is at 1.5%. That's not bad. Again, you can see for context, that's pretty low relative to what we can. When it starts to get up here is what really puts pressure on equities. And so that's not an issue. And then finally, the other kind of better factor for the markets here is that, we had the breakdown in commodities and we haven't continued to push down, right? It actually looks like it's trying to find a low point here. Crude oil is moving lower, went down every single day this week and a few last week. But breaking the 50-day and well below the 200 and below the value area. So there's a problem there, a little bit of a red flag. But the nice thing is commodities tend to be lagging, and if we do set ourselves up for a rally in commodities, that might get our a good last lift to equities here. Before equities kind of run out of steam, because again, like in 2000. Like in 2021, I believe it was 2021, we're pretty overvalued. We're at 38, I guess. Yeah, 2021 we were also above 38. 2000 was Only other time, in fact, it was 1990, the end of 98 that we got above 38. So the only 3 times that we've ever been above 38 on the CAPE ratio. Unlike 2021, interest rates are a lot higher. They're not as high as they were in 2098, but they're pretty high relative, especially very high relative to where they were in 2021 when we were still pretty close, pretty much sitting at 0% then. So much higher interest rates, so a little bit higher bar that we need to clear to maintain the high valuations. And like I said, we're up 28%. In the last 4 months from April low to now, and that is a really good 52-week return, 28%. So we could go sideways, 0% return for the next 8 months, and still have a very strong 52-week return, rolling 52-week return off that April low point. Very strong. And so, it might go up a little bit more, but that kind of gives you an idea that, as good as this run has been, especially with that CAPE as high as it is, it's going to be hard to maintain this pace. And that doesn't mean that we're just okay. We're going to go up still every other day or better, like we have been. But now it's just going to be smaller moves. No, that's not how it works. We'll go up like today, but then we'll have periods of weakness. And, that's just something to be aware of. But it won't be trend change, especially long-term trending weakness. And then, of course, the more we go up, the more likely the rate cut odds drop back down to 0%. And you saw that today. We're pretty bullish today, so the rate cut odds dropped down a little bit. Right? It's still very high, but it dropped back below 90. So the no rate cut odds jump back up to double digits for the first time this week. The more bullish days we stack in the next week and the week after, which I expect, then this number will start to ramp back up towards 40% or higher, and this will start to drop down to 60% or lower. That's okay. Remember, the markets are more bullish when they're not cutting rates. If we start cutting rates, and again, you can see it's going to be very hard to push to a 52-week return that's higher than 28% that we're already at in the last 4 months coming off that April low point. So it's going to really put a damper on what the markets can do over the next so many months. And we don't want that, right? We want, to continue to push a bit higher. And so we want these, at least push this off to December. I believe it's probably our best case scenario is to push this cut off to December, skip that October meeting, skip to September. They always skip the off meetings where they issue projections. They don't issue projections until December. And that's probably the more likely, probably the best case scenario for the markets before we start to get some volatility there at the beginning of next year. So we'll get a good run, bullish run into the end of the year before we start with that rate cut cycle. And that brings us to our trade idea of the day, which is kind of semi-technology related, but it's actually in the healthcare sector, and that's Abbott Labs. Abbott Labs breaking out. We had such a bad drop on its earnings here, but since then it's been gradually recovering and filling in the gap. And then today you can see a nice little breakout pattern above these pre-earnings peaks. Dark green shading in the green line, the intermediate line crossing above market sentiment into bullish territory. Good, strong near-term rally. It's been going for a while, so we'll probably have a little bit of a near-term pullback. But a good, strong near-term rally there. You can see the weekly chart. We've got a green arrow. We're back above the 10-week moving average. It's rising. The PPO is turning back up again. That's a very positive development. Obviously, we have 3 green arrows on the chart with the green line now on the moving average after having had 3 reds and a red line here for a while. So nice little change of trend potentially there. The 3 green arrow chart, we're breaking above the value area. We're breaking through this volume node above the 50-day moving average, strong MACD and stochastics. That looks really good. Looking at the DMI, you can see we are above 25 on the positive indicator, below 20 on the negative, so kind of just starting potentially a bullish trend. That's a common theme in some of these other oscillators. They kind of looks like they're just starting. We're above 60 on the RSI. The weekly CCI is crossing above 0, so a change in direction there for that stock from a trending standpoint. The Ichimoku cloud, we're into the cloud. We're almost through it. You can see that cloud's very narrow here, and the green line's crossing above the blue. The rate of change has turned positive today. We started a new week bullish trend today. weak bullish, right? So it's still weak, but at least it's a trend, right? At least it's trending in a direction. And then finally, your Bollinger Bands, you are not above the upper band, but as I mentioned in a technical analysis class a week or so ago, that one of the good bullish signs, there's multiple different bullish patterns that we like to trade from a directional standpoint. One of them is when you have a wide bandwidth because you are you expand it to the downside, but then you cross through the 20-day average and it's still wide and you can move up to the upside. That's an opportunity. We're in the upper quartile of the bandwidth. Momentum is rising. The bands are outside the Keltner channel. So we have an opportunity to be directionally bullish. So let me bring that up here. Let's bring up Abbott. And what we decided to do today for our trade idea was to do a long call vertical spread, selling that 25 delta. So selling the 140, buying the 135. Just for some context on where 140 is, let's bring up this chart. So 140 is pretty much right at the 52-week highs. So we'd be looking for new 52-week highs for it to get up above. This is what it looks like here. Let's just take a look at the long call vertical. And there's some flexibility because, like I said, we might, we've been on a pretty good near-term rally for a while, so we might get a little bit of a pullback. There's some flexibility there for a near-term pullback. But you notice there's a pretty, it's about a 1.5 to 1 reward to risk ratio, roughly. So that tells me that there's a pretty decent probability, higher than what the volatility suggests because of what the return is. So I think we have a good chance for this to continue to move higher based off of this breakout pattern, and that's our trade idea for today. All right, well, that wraps up our Friday video. Right, this is a preview that you can you get access to the full version today for free. All of our foundation members and higher, all of our subscribers get access to the full 30-minute video or so every day in the week, including the trade idea, including the Market Outlook Live, where we manage all those trade ideas, and including the Market Outlook Live Trade Tracker, where we track all the results of those those daily trade ideas that we do in the Market Outlook. Again, all that's for $29 a month. The returns so far this year up to this point have far exceeded that. Even if you do the yearly, which is $299 a month, where you get 2 months for free out of the year. Again, the returns far exceed that, and that opens you up to be able to do a lot more with what you're gaining on that, depending upon, of course, how you manage your risk. And we manage it very simply because we do it so that we manage the risk so that people can be able to do this without having a large account necessarily to have to be able to trade. Again, thank you very much for watching. I appreciate it. Remember to subscribe to our YouTube channel so you get and ring that bell down there so you get notified when these preview videos are posted every day, the 5-minute versions. Comment on the video down there, share it with others, like it. The more you do those things, the more it helps get the word out to everybody. That's why I always ask. I appreciate those who do that day in and day out. Follow us on Twitter, Facebook, like our content there, LinkedIn, all of our social media accounts. We appreciate that as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.